The preparation of consolidated financial statements under IFRS 3 business combinations, IFRS 10 consolidated financial statements, and IAS 36 impairment of assets requires careful accounting for acquisitions and disposals of subsidiaries. A business combination gives rise to either goodwill, representing future economic benefits arising from unidentifiable assets, or, in exceptional circumstances, a bargain purchase, where the fair value of identifiable net assets acquired exceeds the purchase consideration. Furthermore, when a parent disposes of its entire investment in a subsidiary, control ceases and the subsidiary must be removed from the consolidated financial statements. These accounting treatments ensure that group financial statements faithfully represent changes in control, ownership, and economic resources while maintaining consistency with the single economic entity concept underlying IFRS consolidation principles. Consolidated goodwill. Goodwill arises when the purchase consideration paid by the parent exceeds the fair value of the identifiable net assets acquired. It represents future economic benefits arising from assets that cannot be separately identified or individually recognized, including expected business synergies, customer loyalty, skilled workforce, brand reputation, market position, and future earning potential. Under IFRS 3, consolidated goodwill is calculated as fair value of consideration transferred, fair value of non-controlling interest, fair value of any previously held investment, minus fair value of identifiable net assets acquired. The identifiable net assets include all recognized assets and liabilities measured at fair value at the acquisition date, including fair value adjustments and previously unrecognized identifiable intangible assets where recognition criteria are satisfied. The resulting goodwill is recognized as an intangible asset in the consolidated statement of financial position. Importantly, goodwill exists only in consolidated financial statements and does not appear in the subsidiary's own financial statements because it arises from the acquisition transaction rather than from internally generated business value. Subsequent accounting for goodwill. Unlike many intangible assets, goodwill is not amortized because its useful economic life cannot be measured reliably. Instead, IAS 36 impairment of assets requires goodwill to undergo annual impairment testing, regardless of whether impairment indicators exist. Goodwill is allocated to the cash-generating unit, CGU, or group of CGUs expected to benefit from acquisition synergies. The carrying amount of the CGU, including allocated goodwill, is compared with its recoverable amount, defined as the higher of fair value less costs of disposal, or value in use. If carrying amount exceeds recoverable amount, an impairment loss is recognized immediately in profit or loss. Impairment losses are allocated first to goodwill before reducing other CGU assets where necessary. Unlike impairment losses on many other assets, goodwill impairment losses cannot subsequently be reversed, even if recoverable amount later increases, because internally generated goodwill cannot be recognized under IFRS. This conservative approach prevents overstatement of acquisition-related intangible value. Bargain purchase. Although uncommon, circumstances may arise where the fair value of identifiable net assets acquired exceeds the fair value of purchase consideration transferred. This situation is known as a bargain purchase or negative goodwill. Possible reasons include forced or distressed sales by financially troubled vendors, liquidation or restructuring situations, urgent disposal requirements, favorable negotiations, market inefficiencies or valuation errors. Before recognizing a bargain purchase gain, IFRS 3 requires management to reassess all acquisition measurements, including identification of acquired assets, identification of assumed liabilities, fair value measurements, purchase consideration, non-controlling interest valuation. This reassessment reduces the risk of recognizing gains arising merely from measurement errors. Accounting treatment of bargain purchase. After reassessment, if the fair value of identifiable net assets still exceeds purchase consideration, the excess is recognized immediately in profit or loss as a gain on bargain purchase. Unlike goodwill, bargain purchase gains are not recognized as reserves or deferred income because they represent an immediate economic gain arising from acquiring net assets below their fair value. Recognition in profit or loss reflects the increase in group wealth resulting from the advantageous acquisition. Bargain purchases are relatively rare because competitive markets generally ensure that acquisition prices approximate fair values. Disposal of a parent's entire investment in a subsidiary. When a parent disposes of its entire investment in a subsidiary, control ceases immediately. Under IFRS 10, the parent must recognize all assets, liabilities, goodwill, and non-controlling interests relating to the subsidiary from the consolidated financial statements. The gain or loss on disposal is calculated by comparing sale proceeds received, fair value of any retained investment, if applicable, and carrying amount of the subsidiary's net assets, including goodwill. Where the entire investment is disposed of and no interest is retained, the calculation simplifies to disposal proceeds minus carrying amount of net assets, including goodwill. The resulting gain or loss is recognized immediately in profit or loss. Any cumulative balances previously recognized in other comprehensive income, OCI, relating to the subsidiary, such as foreign currency translation reserves or revaluation reserves where required by IFRS, are reclassified or transferred in accordance with the relevant accounting standards upon disposal. Disposal in the parent's individual financial statements. In the parent's separate financial statements, the investment in the subsidiary is recognized as a financial asset rather than through consolidation. Upon disposal, the parent recognizes cash or consideration received, derecognition of the investment carrying amount, and gain or loss on disposal in profit or loss. The gain equals the difference between sale proceeds and the carrying amount of the investment recorded in the parent's individual accounts. No consolidation adjustments are required because separate financial statements account only for the parent's direct investment. Disposal as a discontinued operation. Where disposal represents a major line of business or geographical area of operations, IFRS 5 non-current assets held for sale and discontinued operations may require the subsidiary to be presented as a discontinued operation. The statement of profit or loss separately presents profit or loss from discontinued operations and gain or loss arising on disposal, net of taxation. Separate presentation enables users to distinguish continuing operations from activities that will not contribute to future group earnings, thereby improving the predictive value and comparability of financial statements. Financial reporting significance. The accounting treatment of goodwill, bargain purchases, and subsidiary disposals reflects fundamental IFRS principles concerning business combinations and changes in control. Goodwill recognizes future economic benefits arising from acquisitions, while annual impairment testing ensures that carrying amounts remain recoverable. Bargain purchases recognize exceptional gains arising when net assets are acquired below fair value, following careful reassessment of acquisition measurements. Finally, disposal accounting ensures that subsidiaries leaving the group are removed from consolidated financial statements and that resulting gains or losses are recognized appropriately. Collectively, these principles ensure that consolidated financial statements provide a faithful representation of corporate group structure, acquisition performance, and changes in ownership, enabling investors and other stakeholders to make informed economic decisions based on transparent and comparable financial information.